They're like, let's try to make the most boring song ever. Well, they might have nailed that. Anyways, good morning, everybody. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades. With that being said, I got to do this disclaimer. All right, let's do the disclaimer. There it is. Let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hey, my name is Wayne. Thank you for being here. Let me know how it can help. I think we should go through commodities like gold, oil, and Bitcoin. I think we should look at dollar pairs and yen pairs, and I think that's about it. A lot of crazy volatility going on in the world, but we're in a moment of known unknowns, I suppose. Known unknowns. And so we've been talking for, about a week that Thursday and Friday were going to be massively important. Okay, so they were massively important. So very interesting. So here he is. Now we got to deal with that, and that leads to volatility. Sometimes volatility is good. Very often it's bad. Got to clean the Tom Fords. Can you see that? Look at that. Crazy. I'm constantly cleaning these things. I guess they don't make glasses out of glass anymore, huh? I'm kind of new to the whole thing. But anyway, so let me know how I can help. And really, we have to start thinking about next week and the rest of the quarter. Today, to me, is sort of almost irrelevant. So if you look at the description below the video, you'll find a link to my book, Strategic and Tactical Forex Trading. You'll find a link to my community, fxbootcamp.com. There are other resources like a link to tradersway.com, an ethical foreign exchange broker with a business model based on a symbiotic relationship with you. Well, that's a big fancy word for saying that they need you to succeed if they're going to succeed. They value you and they want you to be educated in the world of trading. Just maybe it'll help you succeed. Cool. So, tradersway.com. Visit them, open up a demo account, and allow them to earn your loyalty and respect like they earned mine. I recommend tradersway.com. Tradersway.com. So what are you guys up to? Johnny's just scalping the WTI today. Right on. See, look at this. I just spent all that time cleaning these glasses. I don't think it's Tom Ford's fault. I think it's whoever made the lenses. Okay, so mixed bag here looking at commodities. Like it's a bit messy. I don't mind allowing bulls and bears to fight this out for a while. You see, yesterday we had a big drop. Like, basically everything dropped a ton and rallied a ton, right? Well, one thing I might show you is that large institutional investors obviously had trades already in the market. They said, hey, if Bitcoin drops to 18,000, buy it. I don't know if I agree with them. It doesn't matter if I do or not. But your key takeaway should be, hey, you know what? I think somebody planned all this in advance. Okay? That's what your key takeaway should be. Somebody had all of this planned in advance. They said, if Bitcoin drops to 18,000, buy it. If euro dollar drops, if pound dollar drops, so on and so forth, then buy, and they did. That was their decision. Long ago, in fact, most likely. So anyways, going on to WTI, much more interesting, huh? Yeah. Okay, let's take a look. What do we have going? Okay. It's interesting. This template's not set up properly. It's got Asia and Europe. Must have set it this way for coaching for some reason. I don't remember why. I haven't. Is it this one with traps? There you go. That's the standard one. So Johnny's trading WTI. That's cool. So here's the trap, the daily trap. Pachow, pachow. See how that works out? Yeah, I agree. Hope's right. We need... I think said differently, Hope. I think the next round of institutional traders should be boot campers. Yeah. Okay. So now it's ready just for a standard trap and break strategy. I like to look further out as well. Okay. And really, when I look at this time frame, it's a bit neutral. Okay. I'm a long-term bull. Okay. I think there are structural problems in the market. Even cyclical. I mean, this is when we're supposed, like, refineries this time of year, what happens is they go into maintenance mode, right? They go into maintenance mode. And then we need to rebuild our inventories of things like gasoline in the spring. And, well, to make gasoline, you're going to need WTI. And so we're entering into a period here where maintenance should be wrapping up soon. And that those refineries, the reason they do maintenance is so that they're all clean and shiny and spick and span, ready to take on crude. Okay, so anyways, this should be going up, you'd think. So, anywho, if we look at this here, okay, and then you want to do this probably, and if you want to do this, okay, there we go. Denise said, hey, Morgan Stanley, JP Morgan, Citi, and Wells Fargo all beat earnings estimates this morning, which I mentioned is a high probability last night. Yeah, I did. Now, I have to apologize. I even talked to my daughter about it. I think I did a very poor job yesterday in the swing trading group, and I apologize for that. Long week, I guess. Just a long week. I think that's kind, Jim. Yeah. Thank you. So anyways, my oh my WTI, and it's like one of these things. If I were a bull and I were to marry, right? Yeah, look, these are the prices. Now, there's not much change here. In fact, about a week ago, I did the same analysis. Now I've just done a clear chart. Really? I think, now I'm going to argue. I think you guys are kind. Yeah. So I appreciate that. That's all I'm saying. Okay, so I actually did this even a week ago. Oops. So I redo the analysis, and it's the same thing, right? This is a plan A. If you recall, I used to have this whole area scoped out, basically No, I think not basically, actually just a fib zone. But plan A is still there. Oops, I wanted that to be pink. Come on. There we go. Plan B kind of like that, right? Oh, okay. Well, I'm not going to argue with you, Jim. That's for sure. Hey, by the way, when I stay up after work and I'm too tired to fall asleep, I have nothing to do. I get a glass of wine and a snack, and I sit in front of the TV, and I turn on regular TV. It's really interesting. Just regular TV. And it's not very good, by the way, regular TV. And I find the ads the most interesting one. And every night right now, they're asking people if they have ever lived on Camp Lejeune. You ever spend time on Camp Lejeune? You might be. They have $35 billion set aside for people that spent time in Camp Lejeune. And I thought, maybe Jim should get some of that money. $35 billion's a lot. I think it's North Carolina, isn't it? Just like, wow, that's a lot of money. Somebody must have royally screwed up. Holy moly. So if anybody here lived in Camp Lejeune, you might be entitled to money. What's interesting is there's 3 or 4 different law firms advertising for the same thing. Yeah. Yeah. 35B is a big number, man. Okay, so did we do everything? No, we need to do some gold. All right, let's do some gold. So I basically need to set up WTI, right? Frasier episodes. That's cool. Frasier. Yeah. Yeah, they were good. They were very much of their time. Good, like a good, just anyways, I never watched anything, so I only am aware of the shows, but I think they were quality at the time. All right, let's see. So I have a short on gold. I've covered it so many times. I'm just going to say you should already know why I shorted gold. It's Friday, man. I'm exhausted. I'm tired. But I am happy. So I'm just saying you should already know why I shorted this because I've talked about it so much. So anyway, so I'm short off of a 4-hour 21 deflationary market. And basically it's a swing trade. So if I get this right, I guess what I could do to make an illustration here is I'll put it, yeah, I guess here's fine. Okay. Yeah, I'm excited because there's a lot of interesting things that I want to do. The super secret, fundamentally based alert service. I need to roll that out soon. My PhD support person has taken time off to get married, so that project is stopped. I think about it, but I just haven't done any development work. but I want to get that going. I keep thinking about us meeting up in Nashville, Tennessee. I don't know when to do it. Maybe we can do a small trial run in the spring. But I thought, wouldn't it be cool if we met every January right after the holidays, like right in the early part of January? Let's say, I'll make up a date. Let's say Wednesday, Thursday, Friday, or Thursday, Friday, Saturday. Yeah, Thursday, Friday, Saturday after non-farm payrolls. The week after January non-farm payrolls, right? The weekend after. What if we did that every year? Every year we met up for some training and some basically just a gathering, a get-together. You know what I mean? Some of it's, we'll have a nice party, we'll have a nice dinner, but really hanging out with other boot campers. I used to do it all the time. I used to do it every year. And I've seen amazing things, like an entire group of people of which everyone is teary-eyed or actually full out crying. Because, yeah. So maybe we need to do that again. I kind of want to do stuff like that again is all I'm saying. So I think about this all the time. So I'm like, you know what? I should probably just stop thinking and start doing. So anyways, that brings me happiness when I think of it, just so you know. Anyways. Right, so anyways, so there's the gold. Got a little front run. I can't lose money. What do you think of that? I can't lose money. Sounds good, right? It's a good start. And we'll see. We'll see. I don't know. I don't have a lot of faith on it. It's just a trade. But it is sort of like an aftermath trade. Okay. Yesterday had high volatility. I told you. Okay. So we might as well get in with the dollar now. And, I'm still on this? Oh, look at that. Still on this at break even. Really? I'll have to take a closer look, see what's going on here. I've forgotten about this one. Bo bo boom. Bo do do boom. Ba ba do. Ba do 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 do. Ba do do boom. Boop 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 boom. Bo do do. Do 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 do. Huh? I don't remember this one at all. Yeah, I don't really remember this one at all. So I guess I can't really do anything about it. It must have been, it looks like it might have been a 4-hour 21 short. And then I placed my stop above something. I don't know. I don't remember this one. It's just starting to go profitable again. So I guess there's nothing to say about it. Maybe, oh, there it is. Oh, I see what I did. Yeah, I sold the daily 5. You could also see it's got a built-in swing trade, right? So I can throw down a target here. Looks like I'm going to call it an M3. So I'll put this at an M1. Should be able to suck a couple hundred out of that. Interesting. I'm selling gold and I'm selling Aussie against dollar. It's kind of the same trade twice, isn't it? I don't know how I feel about that. Oh, yeah. And the other thing I was telling you that I've been thinking about and brings me joy and happiness, and I just need to start manifesting it, would be writing a manifesto. A manifest. I need to start writing the books. I thought, yeah, maybe that's a 2023 thing. My kids study hard all day and all night, and I look at them and I miss them. I miss studying. So maybe writing books will bring some of that joy. Richard's got the same trades. Right on, man. Okay. Anyway, so knock this out. You'll see that I'm looking at everything from a daily point of view because I don't get sucked up into the vortex of nonsense and mediocrity. So I just back out and I'm like, oh yeah, nothing's changed. Yeah, that was really exciting. So I was telling the swing and day trading groups last night, I'm like, this big volatility that we had yesterday, where it dropped like a ton of bricks and then skyrocketed and then came back down. Well, we're back right now to basically where we were. I got knocked out of all my trades profitably right before the news. And everybody knew where my stops were. I was moving them based on PSAR, so I got knocked out because I lost my good volatility, and then, of course, the bad volatility showed up, and I'm like, I wasn't even in those trades. It was irrelevant. So, yeah, cool. So we had that huge day yesterday. Like, let's look at euro dollar, the most liquid currency pair in the world. We were here before the news. Then price fell down to here. Let me just use the arrow. Okay. Price fell down here. Then it went up here. And now it's come down to there. Nothing happened. Well, studying is good for sure, Richard. Right? For sure. That's the key, I think. So what I identify is I look at this as a high. I look at this as a high. And I would guess, now the concern, of course, let me put this like as a low. There's a low and then a higher low. So that's the concern. Milos, Thursdays at 2 p.m. Tuesdays at 2 p.m. It's 0.01. Okay, let me show you the indicators. Parabolic, stop and reverse. 0.01, a maximum 0.2. Usman says, hey, do you think pound dollar will continue to fall and drop off the daily chart? Do you use Fibonacci retracements? Absolutely, Boris. It's just price action. Do I think the pound dollar will fall? Okay, so you're asking me a think question. Okay, I'm good with that. So there are two things that you have to, incorporate in your answer. Okay? There's market. And there is price. Okay? I separate them constantly. I use moving averages. The 2155 represents the market. And price is represented by the 5/8. Okay? So I could answer this right now. This market is technically bearish. So your question, do I think the pound dollar will continue to fall? Well, the algorithm that draws the colors, that's what it says. Oops. Did I just kill it? Okay. So anyways, the 21 is below the 55. Oh, it's bearish. There's no doubt about that. But according to price, we're braiding, and this is bearish neutral. So let me write this again. So the market is bearish. And price is not bearish. So that's useful information. But technically speaking, this is bearish all day long. Okay, now I can use oscillators like MACD and stochastics. I don't have them on this chart. Okay, MACD represents overbought and oversold conditions for market. The stochastics shows overbought and oversold conditions for price. Once again, I try to line them up so that I'm a bear in a bearish market. I want to sell in a bearish market. I want to sell in a bearish market. I want to sell in a bearish market. Okay, I want to sell in a bearish market. That's all it is. So when price is rising in a bearish market, I don't want to be in the trade. Do you understand? That's simple. So the other thing that I look at here is all this technical analysis. Still, you could break down to simply price. Price and time representing market sentiment. So these bigger moves that have occurred recently could be a change in sentiment and could eventually lead to something like this. Could. It could. It might. Dang it. I deleted it again. Market price. Okay. However, when I decide my bias for the market, I also use trends in economic data. Okay? Like growth, inflation, jobs, and interest rates. Okay? I will look at trade positions of institutional investors. I'll look at trade positions of retail investors. I'll look at seasonality so that I can go back 50 years and say what normally happens this time of year. Okay? And I compare, so if I'm looking at pound dollar, I would compare all this data to the pound and all this data to the dollar, and I get a market bias. But then I also want to look at technicals, because they're sort of like what should happen. You know, we live in a world where you can play poker, for example, and you know there's only a 1% chance that the next card is a king. So you bet against it, and boom, the next card is a king. 99% chance the next card was not a king. Boom, it's a king. And you're like, well, hell. Okay. So there's probabilities. And of course, all of this changes over time. All of this is fluid. But the thing is, economic data doesn't change very often. When you look at seasonality, you're looking at a 5-year trend and a 20-year trend. That doesn't change very often. And when you look at institutional trades and positioning, it changes, but it takes months for them to change dramatically. So it helps you calculate the probabilities. Look, if all institutional traders are short this, maybe buying right now is just simply price reacting to something else. Short-term sentiment, let's say, or maybe we've just hit a whole bunch of profit targets. What if it was just profit taking? What is known as a dead cat bounce. See, this big drop down here, this big crash here, took me out of all my short positions. I hit all my limit orders. So you can imagine the whole market got taken out here. All the bears got knocked out for profit, and anyone long this, they also got knocked out for loss, and it was just left with nothing. And now we got to figure it out, right? Oh, the government changed their mind. Oh, the government changed their mind again. Oh, the government changed their mind again. Oh, Quartai is fired, right? Oh, he's fired. Someone else is going to come in. Someone else is going to do it. Oh, they're going to do the same thing. No, they're radically different. And, over time, maybe things like trade positions change. I don't know. Okay. But the question is, will this continue down? Well, has anything fundamentally changed? Well, stuff that's not on here, it's a little more high frequency, would be, has the central bank inside of this changed their policy? Well, 99.9% of the time, a central bank with certain economic conditions will have one policy: to kill inflation or to create inflation, for example. To kill growth or to create growth. That's really all it is, isn't it? Well, how often is it that a central bank is killing inflation by raising interest rates and creating inflation by basically doing quantitative easing? It just don't happen none. Okay? It's like, I think I've seen it twice. This is the second time I've ever seen sort of dueling banjos at a central bank. The other one was Bank of Japan several years ago. So you have to add that and say, well, does that create some up? Yeah, it does create some up. But what if they stop on the 14th? What if all the problems that created this giant downward spiral? Can we call that a giant downward spiral? Can we just say for quite some time now, most of the year, this has just been down? So, again, I'm trying to answer the question. Do I think the pound dollar is going to continue down? Well, the question you're asking is, has the government and central bank fixed the problems? Maybe bears don't want to be bears if the central bank is buying bonds. Is that valid? Maybe the bears come back when the central bank stop buying bonds. And we take this down all the way down. Okay? What do you think? Okay. Frank, I've actually talked about that multiple times at Forex.Today and in my day trading group and in my swing trading group. So I'm not going to do it again. Maybe you might have to go back. It's just like, dude, it's irrelevant now because it's already happened. I talked about it 3 or 4 or 5 days ago. Okay? So now that it's happened, it's irrelevant. It's all, I've already made those trades kind of thing, right? So to talk about it now, it's like, oh, look, I was right. Yeah, well, look, I thought about it. I was probably going to be right. Okay. So anyways, so maybe go back, but I definitely have talked about it. Okay. But I don't think you need to be focused on it now because it's already happened. So I hope, Usman, I didn't tell you an answer, but I did explain how you get to a conclusion. I don't know what your conclusion would be, but that's how you break it down and digest the information and then spit out a conclusion. Richard says, that's why I asked, does the currency follow the bond price because the Bank of England is buying bonds? Well, yes and no, but certainly. The only thing I really care about is the policy of the central bank. Okay. Now, one thing I talked about, I think it was yesterday or the day before, is, and it's something for you to think about. It's a thought that I want you to think about. I proposed that this is the dollar index. This is the dollar versus every currency on the planet. I proposed that the dollar's not strong. So last night, I was looking at wine. I look at wine a lot. I know what the price of these bottles are. Okay. I'm looking at wine I've bought many times. I bought cases and cases of one particular bottle at one point. No, not at one point, over time. But I have bought cases of it too. So I really do know the price of the wine I'm looking at. I'm just standing there and it's $4 more per bottle. Now, it's not an expensive wine, so another way of saying it is, I don't know, let's say it's gone from $10 to $14, right? That kind of thing. But that's a huge percentage increase. If the dollar was strong, that would be deflationary. It should be cheaper. That's kind of one. And then I went and looked at some other wine, which is the next level up. And instead of being about $19 a bottle or $18 a bottle, it was like on sale for $25. And then there were others that were on sale for $35. And I'm like, $35 for this stuff? Like even the sale price was significantly higher what these bottles were priced at just a few years ago. So I look at them like that's unbelievably inflationary, but a strong dollar would be deflationary, especially against foreign currencies. So I look at this and it looks like it's up, but as I discussed before, if it's up, then foreigners are buying it. And they're buying it so they could buy oil, but oil's down. Or they could buy treasuries, but treasuries are down. Or they could buy the stock market, but the stock market's down. So I don't think anybody's actually buying it. What are they buying with their money? And then I look at the wine, and wine is up 30%. But I thought the dollar was strong. Nope, not according to the wine prices. That would indicate my dollar is weak. Do you understand that point? I'm looking at it and I'm like, it's a pair like this. Oops, that's too thick now. Okay, let's try this again. Delete. Okay, it's a currency pair. wine, USD. Okay? And wine is up and dollar is down. I'm looking at it. I'm doing the conversion. I'm standing in the grocery store and this is what I'm thinking about. The wine USD pair is up, which tells me dollar is weak. But then I look at the index and dollar's strong. No, it's not. So Richard says, you mean the uptrend's coming to an end? No, I didn't say that. My point is, everything else is way, 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 way worse. Isn't that interesting? Dollar sucks. But pound and euro and Aussie, as an example, are horrible. Horrible. Dollar looks good in comparison. And I think, well, if that's the case, I think things can get worse. I think Europe gets worse. The UK gets worse. Okay. I think we're going to get some interesting news out of China this weekend. So maybe Aussie's a rebound. I don't know. But if things are that bad, I don't see why they can't get worse. Okay? You understand? If things are bad, I expect them to get worse, not better. Zach says, Wayne, what would cause the stock market and the bond market to be down at the same time? Money is being destroyed, essentially, right? Your investment's coming out. Okay? So let's say you bought a 10-year T note, Zach, a couple years ago, and it pays 2%. Okay? And the face value on this thing is $10,000. Okay? It's a 10-year T note. You bought it a couple of years ago, so there's still 8 years left. So I can actually do the math here. I'm not going to, but you can do the math and figure out to the penny what it's worth. But right now I can go straight to the government, okay? And I can give them $10,000, or at least a bond dealer, okay? And it pays 4%. And over 10 years. So if you think about the math here, these are just income streams. Okay? 2% a year for 8 years, plus at the end of it you get $10,000 back. There's a value. You just do the math. Time value of money, right? Great. But obviously this pays twice as much for a full 10 years. Obviously this one is worth more. So therefore this one is worth less. So if you were to say, hey Wayne, don't buy a new one. You don't want to be locked up for 10 years, Wayne. You might regret 4% might be not good enough. Why don't you buy mine? And now we'd have to compare these, and you would have to lower your price to the point where, based on price and this income stream, I'm indifferent. To me, it's irrelevant. And maybe I do like the idea of just being locked up for less. Or maybe you lower your price just a little bit more and it ends up being a better deal. But notice what's happening is prices are falling because yield on the 10-year T-note is rising, because the Fed is raising interest rates. Okay. Usman says, do I think Bitcoin will fall to 10,000? Last night in my swing trading group, I talked about it falling to 5,000. But you'd have to be part of the group to understand why. Hope says, the dollar's the best house in the worst neighborhood. I think it's the only house that hasn't burned to the ground during the firestorm. Back when I was a kid in university in the 90s, the first time I was in university, I was in the South Bay, and I had friends in going to Berkeley, way up on the east side, northeast side of the San Francisco Bay Area. And he and a bunch of guys rented a house, which I would call a beautiful, almost mansion. Modern, right? A modern, beautiful house in the Berkeley Hills in the 90s. And they got a sweet deal. They basically got it for ridiculously cheap. That's why these 3 or 4 college guys got together and they just rented it. And for a year lived in a mansion on the hills. Now, why do you think they got a sweet deal? Well, earlier in the year, something like 3,000 houses burned to the ground in the Berkeley Hills. This one, for whatever reason, the house below it burned to the ground, nothing left, not even a foundation. The house on the left of it and the house on the right of it, now these are in the Berkeley Hills, so they're not like touching each other like the rest of California, but they're close, but yards away instead of inches away. So the house to the left, the house to the right, they burned to the ground. There's no fridges, no appliances, there's no walls. It was so hot, there's just literally nothing. The house above it, just set back a little bit in the beautiful trees. Well, all the trees are gone. And that house burned completely to the ground. Nothing. The fridges are melted. The stoves are melted. There's literally nothing left of these houses. But this one house, untouched. Just amazing. Just amazing. Just crazy. Amazing. So, it's not that it was the nicest house or the worst house. It's the only house left. It's the dollar just hasn't burned to the ground yet. It might actually be on fire right now. But it's better than all the other ones. Okay. Zach says, I thought high yield was favorable. Yes. Okay, so let's talk about this, Zach. I can get you a sovereign bond right now. Maybe we'll look it up. Let's look at it. Let me get some numbers here. Boo-doo-doo. Ba-ba-ba-bum. Boo-doo-dum. Do-do-do-do-do. Oh, I must have clicked an ad. Google does a trick now and it bugs me. right before you go click the link you want, all of a sudden it pops up an ad and you end up clicking the ad instead of the thing you wanted to click on. I think it's a dirty trick. Let's try it now. There we go. All right, let's take a look. It's loading. It's loading. Is there even data here? Maybe it's not even loading. It's not loading. It's not going to load. Well, okay. Well, thank you for nothing. Hang on, we'll get there. Maybe this one will load. Once again, there's a website that says they have the data, and then you click on it, and there's no data. Hang on. Maybe this one. Sorry, it's not gonna. All right. Well, then I'll give you I'll make up an example. Okay. This goes to Zach. He wants to loan money based on the highest yield. Okay, cool. We'll call this country XYZ. So XYZ country is issuing a bond right now for 12%. United States is paying 4%. Which one do you want? Boom, 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 ba-da-doo, ba-da-ha, oh. You don't have enough information to make that decision, Zach. Okay, so what if this country had 20% inflation? Okay, then you are guaranteed to lose 8% a year. Because when you, at the end of the year, you're going to collect 12% more of that country's money, and then you're going to convert it into dollar and bring it home and find out that you've actually lost. Because when you bring it back, you try to convert it, and you're going to get 8% less US dollars. There's one way of looking at it. Less than you paid. You see the issue there? Plus, you probably have to then think about, well, which one has more risk? Is the economy growing or contracting? Do they make their payments on time? Their level of inflation is a form of default, in my opinion, because they're paying you back with less money, right? So anyway, so based on risk and the health of the economy and a bunch of other factors, right, you should probably be compensated. But we call this the real yield, okay? So these guys need to raise their interest rates to 22%. And even then, you're probably not fully compensated, because when you do some form of risk-adjusted performance analysis, your 4% guarantee in a reserve currency, okay, well, you don't have default risk and you don't have currency fluctuation risk because it's priced in the reserve currency. So you face less risk right off the bat. And so when you do all these calculations, risk adjusted and stuff, this dollar for dollar, you're just better off because you're going to get your 4%. That's it. So now it's a done deal. You don't need to earn higher because you don't need more than 4%. If you're going to invest into XYZ country, let's say it's an emerging market, there's all kinds of craziness. There could be a coup d'etat, right? They could just, their central bank could go even crazier than a normal central bank goes crazy. Just all kinds of weird things can happen. See, right? And you get a country like Argentina, no one would ever lend Argentina money and for only 20%. Okay. Okay. You got to be compensated for your risk. So think of it like a wildcatter. You got a lot of money and, you meet somebody and he says he drills oil wells. So you strike up a conversation. You like the guy and he says, oh, by the way, I have an interesting opportunity for you. Loan me $8 million. I'm going to drill one hole. I'm pretty sure oil's there. I done my darndest to make sure the oil's there, but I ain't got no money. So why don't you pony up the $8 million? And if the oil driller, the wildcatter, actually strikes oil, he'll give you your $8 million back plus $10,000. How does that sound to you? There's a high probability he's not going to hit the oil, but he's pretty sure. Gives you his word. He's thought about it real long and hard. Would you take the deal? Would you pony up $8 million to make $10,000? The answer is you're not being fairly compensated, right? So now what? Well, you say, well, look, I think there's a high risk that you don't pay me back. So if I'm going to take that risk, I need a higher return. Because I could take $8 million, loan it to the U.S. government, and they will pay me 4% guaranteed. You understand? So there is a number that you will need to make that deal. You're like, hey, if I give you $8 million and you strike oil, I want $32 million plus my 8. So I want $40 million, not $10,000. How'd you get to that number? Well, you did your risk-adjusted analysis and you're like, well, if I looked at my opportunity cost, if I did this, if I did that, I can buy an apartment building, right? Which could produce 8% a year. But that's risky because property values go up and down. You have to refinance it. You have to take care of it. Takes up your time. So you're like, okay, apartment building pays me 8%. A bond, I don't have to do anything except own it. So that's the easiest money. But you're not going to get a huge reward. But if I'm going to risk the whole dang thing on drilling a hole, I need to mitigate the risk and I need to, or be compensated for the risk. And it's just simple. And so you go through the math and you're like, look, if I'm going to take that kind of risk, I need this kind of reward. And bonds are great because it's only math. So if you're a math person, bonds are for you. Bonds are great because you can do all your calculations and you know exactly what everything is worth at every moment, because you can get math and more complicated math, but there's some basic math. You can add variables and all kinds of stuff. But you can build all these models and you know exactly what everything is worth. So you spend most of your time finding things that, because of inefficiencies of some sort, is mispriced. You actually get a deal. And you find them. Okay? So if you were going to lend Argentina money, you would have to do those calculations and you find out that if they're offering you 20%, it's not enough. Because dollar for dollar, you can make another investment somewhere else and get a better return. Your internal rate of return, which is the return dollar for dollar. It's not an absolute number. Okay? It's not, you won't make the most money, but when adjusting for the risk you take, dollar for dollar, internal rate of return after a risk-adjusted performance analysis would say you're way better off either doing a 10-year T-note, but then you might say, okay, well, let's stretch out and take on a little more risk. Let me lend Ford Motor Company money so they can make electric cars. They need to raise $5 billion to create new facilities to build electric vehicles. And you're like, I think Ford is a good company. I think Ford's going to be around. I think they know how to make cars. I think they can figure out the whole battery thing. It can't be, right? They have 100 years of experience building cars, so it makes sense. So you decide to lend Ford Motor Company your $8 million, and they're going to pay you 8%. Now, there's a chance all kinds of things could go wrong. The economy can go into recession, and these projects are delayed. Maybe Ford runs into a battery problem that all electric cars run into. There's just a shortage of cobalt, so they can't make the cars more affordably. They might end up making cars that people just don't want. Okay? And so people will continue buying Teslas, and they're like, oh, that Ford, I don't really like the way it looks, and they don't buy it. So you do face risk, but you think about all of this, and you're like, yeah, but they're still going to sell 2 million of them. Even if people don't like them, they're still going to sell 2 million of them. So you're like, yeah, it's worth it. Ford is going to be around in 10 years, and they're going to pay me back. So, right, it might be 50% more risk than lending the U.S. government money, but you get double the reward. So you're like, I'm going to lend Ford, and I'm going to make 8% on my 8 million. Okay? Hey, which is what, 600,000 a year? Doing nothing. What do you stink? Smell like a plan? Better than owning an apartment building. Well, there's all different reasons people participate in the bond market. Okay, let's say I issue a bond. Okay, let's say I start a bank. It's called Wayne Cap. Okay, Wayne Cap Bank. Okay. And I go to the bond market and I issue a bond. I sell a bond for $1 million. Somebody buys it. So they lend me $1 million. So there's now a bond out here for $1 million. Okay. And now the bank has a liability and I have to pay 4% on this. Then I lend it out as a loan, a mortgage. Okay. So now I have an asset, a loan, and a bond, which is a liability. I have to pay 4% a year. But the cool thing is this loan is at 6%. I went to the bond market, sold a bond. Now I have the money. Then I give the money to somebody else and they pay me money and I clear 2%. And I'm done. So like you have to think like that's one way the bond market is used, but there might be like, what if you're an insurance company and every month you collect $1 million from people that buy insurance from you, and you have to save some money just in case there's a hurricane or an earthquake or a fire. But hey, every month you get another $1 million and another million and another million. It just keeps coming in, and you got to save all of this for a rainy day. And there's always a rainy day. So you need a way to hide that money somewhere and then earn an income. And we call that a float. So if you want to know why Warren Buffett's first companies were all insurance companies, it's because the insurance company, okay, let's just say they have $1 billion they've collected and saved from insurance people, the people that are paying the insurance. So they collect $1 billion, but they have to worry about fires and floods, right? So they have to save this money for risk. So there's $1 billion sitting in the account that they can trade. That's it. It's free money. And when they trade the $1 billion, they keep 100% of the profits. See, an insurance company is a trading firm. It's a bond shop. Okay? People give you money every month and they say, look, it's probably not going to happen, but my house might burn down. If it does, pay for the repairs. They're like, cool, pay me money every month. Even though there's less than 1% chance, there's a 99% chance your house will never burn down. But you're willing to pay someone to hold the money for you just in case it actually happens. They're like, well, sure. Yeah. Okay. Send us the money. We'll hold it for you. We'll collect it and we'll pile it up. And if your house ever burns down, we'll help pay for it. But almost certainly won't happen. Cool. Meanwhile, they have this money just sitting in an account in case your house burns down. Well, they trade the hell out of that. It's free money. It's insane. It's just free money. So they sit with their $1 billion and they're flipping that, making 5 or 10% a year, let's say. with free money. Every once in a while, something happens and they got to pay for it. But you see how it's called the float. There's money just sitting there. So you could just take the money and buy bonds, and that's what you would assume an insurance company is doing. So they just have this giant bond portfolio. Let's say when you stagger your bonds for different risk profiles, different periodicities, whatever, you create a portfolio of all these bonds and you mix them all together, low risk, high risk, liquid, illiquid, all that kind of stuff. Let's say you make 5% a year. Okay. Trading other people's money. And that's it. That's your profits. You don't make any money on the insurance, but you make a ton of money on the trading. Because it's not 1 billion, it's 100 billion. Oh, you make 5 billion a year on insurance? No. We sell insurance and we make $5 billion a year because we buy bonds with it. They're a bond shop that gets free money. They're a hedge fund and people lend them money for free. What do you guys think about that? Insurance companies are bond funds. So Zach's like, so I still don't understand the mechanics of the bond fund. Well, of the bond market. Well, there are many different participants playing different games. But all you're doing is either lending companies or countries money. That's all it is. So if you buy a bond, you're a financier. Okay. So you can lend the money and hold it to the end. Or you can change your mind and you can sell your loan. You loaned a company money. The company has has promised to pay you back. But you can sell that piece of paper to somebody else and say, okay, the bank's going to pay you now. Because when somebody buys a used bond, otherwise known as a seasoned bond, okay, you can buy a seasoned bond, a 10-year T-note with 7 years left on it. What's the value of that? You do the calculations. The present value of a 10-year T-note with 7 years left that pays 2% a year, okay, all you have to do is the future cash flow, 2% of the $10,000 this year. Okay, 2% of $10,000 the year after, so on and so forth, extended out 7 years. But then the thing is you have to adjust inflation levels or interest rate levels or opportunity cost levels. Over that time, you're like, well, this year interest rates are high. Next year, they'll be higher. Year 3, they might be the same. Year 4, they might be slightly lower. And you extend out. And money 7 years from now is worth less than just having the money today. So that's why you discount the future value of the cash flow. And you change everything with your interest rate changes. And you come all the way back, and I can tell you to the penny what it's worth. And if you're asking for too much for your 7 year, right, your 10-year T-note with 7 years on it, well, I ain't going to buy it. So you would have to lower the price because you can't change the 2% that it's paying in the face value. You can't change the $10,000 of the face value. You can't change the fact that newer bonds are paying a higher rate. You can't change that. The only thing you can change to get me to buy your seasoned bond is by lowering the price. And right? And if I find it risky for some reason, lower the price. for a seasoned bond with additional risk, again, you can't say, well, I'll change the bond and it'll pay you 5% instead of 2%. Well, you can't do that. It's already issued. So all I'm buying is an income stream. But if I'm worried the value of the currency it's priced in will change, then you're going to have to lower your price. If I'm worried that at the end of the period I don't get my money back, well then, because that's a default, well then you need to change your price. If I just have better opportunities, you need to make it more attractive by lowering your price. And that's why the prices of the bond market are falling and falling and falling. And the government is struggling to be able to borrow cash. It's hard to borrow money when the market's falling, right? So they say, well, what about 4%? Oh, well, maybe 4%. Okay, then the Fed raises interest rates again, killing the economy even more. Prices fall, and the federal government's going to have to offer more than 4% to attract investors. Zach, yes. You don't buy an apartment building because you like people. Your tenants are horrible, horrible people. I think anytime you talk to somebody that owns an apartment building, they want to tell you the horror stories of there's one tenant, right? Like those stories. No, you do it because of the income stream. So you might as well just own a bond. You might say, well, I can make 8% a year owning an apartment building, but I can make 8% a year lending Ford. Okay? The money instead of owning the apartment building. So which one is better? Well, you're lending one $8 million to buy an apartment or $8 million to buy a bond. They both pay 8% a year. So you're like, which one are you better off owning? Well, the apartment building comes with risk, like it's a pain in the ass to own it and run it. Nothing but problems. Ford, you lend them the money by buying a bond and you're done. Well, you're like, shoot, I'll just do the Ford bond. So you look at it, what if you could earn 12% a year owning the apartment building? Ooh, oh well, maybe, right? Does it compensate you for being a pain in the ass? Okay. Yeah. What do they take, Jim? Is it like 10% of the NOI? I would still say if it reduces the amount of work you have to do, I'd pay that all day, every day. Yeah. No, yeah. Yeah, well, it helps you sleep at night. So you would adjust. So like you would look at your bond and you do the numbers. How much are you going to earn? Okay. And then you look at your, if you're going to do the other thing, you're going to look at your rent collected minus your expenses like insurance, like mowing the lawn. Okay. That kind of stuff. And you get your net operating income. Okay. Now you have two other expenses that come off of this. Your management cost, management. Okay. And your mortgage, your debt service, mortgage, okay? And it's significant because this will be, let's say, 6% of whatever, of 80% of the value of your property. Okay? So when you look at, it's just 6% a loan rate, not 6% of an NOI. But then the management fee, let's say, is 10%, but it's 10% of the net operating income. So this might end up being more like, I'll make up a number, 16%, and this is 10%. And you're like, but dude, right? So let's just change it. So at the end of it, you're like, I only get 75% of the net operating income for myself. Well, dude, if that were the case, you got the best deal on the planet. And from that, you probably want to save for a rainy day in case you have to put a new roof on the thing. Okay. But your management fee is quite expensive. But like Jim says, I wouldn't even think twice about it. It means you do nothing except collect the profits at the end. And your real job is to find cheaper money. So when you go to roll over your mortgage, you need a good relationship with a banker. The banker knows you. The banker believes you're Mr. or Mrs. Reliable. The property has maintained value because you've reinvested into the property. You've made it competitive. You bought the right type of property. Okay. People want to live in your apartment building. So it's always, right? There's rarely a vacancy. And if there is, it's one apartment for like 1 week and all of a sudden, boom, you got new tenants, right? And you're charging at the high end rents for the equivalent neighborhood, right? Your rents are high compared to benchmark other properties in the area. People want to live there, all that kind of stuff. And they're like, Jim, you're running a tight ship. This is good. You're reliable. You have good income. You have good credit. Your apartment building is in high demand. There's never vacancies. You're collecting good rent. We are happy as a bank to lend you money for another 5 years. Okay? That's how it's supposed to work. Every once in a while, that system breaks, and there's nothing but snot and tears after that. Oh, those aren't tears running down his face. Trust me, it's not. All right. So look, we had a down, then a giant up, and now a giant down. Oh, look at my Aussie. Now I'm making tons of money. Look at that. Yay. Yay me. All right. I don't know. Look at that. I went from a loser to a break even to a winner. Yeah. Do I hold swing trades over the weekend? Yeah, that's what a swing is. For sure, Manoj. Without a doubt. Okay. Sometimes I hold trades for I'll make up a number, 9 months. Those aren't tears. Trust me, it's not. Hey, that's funny, man. Oh, yeah. Guess that's it. Do you have any questions? Manoj is, or always wait for profit. I never hold losing positions, Manoj. You have to understand that. That's, I'm incapable of doing that. Okay. But I want to let these things run for weeks. Do you understand that? Okay, so I'll give you an example. So should we talk? Should we do gold or oil? Gold's not that great, but I guess we can use it. Okay, gold. I have a pissy little trade here. I essentially sold off a daily moving average or 4-hour. They're all the same. And I have a fundamentally based decision, however. Technically, I took it because of moving averages, but that's the easiest thing. Okay? I can think forward. Okay? I can think forward big time. And so I have a bias, and I'm a huge bear. Despite seasonality, I say to myself, maybe I should sell this thing. So now to get compensated for this trade, so maybe let me draw it with let's do it this way, shapes. Okay. So I would like this to drop for weeks. Yeah, but Manoj, it's like, I would never make a decision like that. I should get out because I have a certain percentage. It's an irrelevant question. That's not the right way of looking at it. Okay? So, for example, this target is based on technical analysis. So if you're going to, so you mentioned a swing. This is how to swing trade. So between now and Monday, if something like this occurs, that will be the target. Yeah. Oh, be careful, Gisa. You know, you're prodding me. But hey, I'm glad you made money, but be careful. That's okay. You're playing a dangerous game. Yeah. Well, the problem is you're going to do it again, and then you're going to do it again. Huh? No, you say no. Okay? Nobody smokes crack cocaine once. I mean, it's a problem, right? I talked to somebody in my life who developed a drug problem, and I said to him, right, I looked him right in the eye and I said, you know, the time you decided to stick a needle in your arm, at the moment you thought that was a good idea. And so, there's no way somebody says, well, I thought about this and, I know heroin is bad for you, but I want to check it out. I mean, it must have been scary too to say, you know what, I'm going to inject this into my arm with a needle. Like, you're doing something bad. You know what I mean? It's not like smoking pot or something where like, hey, dude, you take a puff on this joint. You're like, no. Like, you're going to shove a needle in most people are horribly afraid of a needle, right? So to say, you should be that afraid of high leverage trades. You should be that afraid where you thought it was a good idea. And in this case, it worked. You got a good high, but please be careful. That's all I'm saying, okay? Okay. Yep. So I'm glad you made money, but it does not earn my respect. So just be careful. All right. Wow. So I guess, what? I guess we should go. I mean, did I answer everything? Is there anything else I can do? Okay. Once again, guys, as many of you know, I'm stupid. I don't think. So when you say, Wayne, do you think the dollar is time to sell? I don't think at all. I only have facts in front of me. It's not my job to think. Okay? I'm a concert pianist. Somebody puts music in front of me. I don't care if it's Beethoven or Haydn. Irrelevant to me. I'll just play it. They're notes on a page. Okay? So, I have technical analysis here. This says down. That's not my opinion. I can play the sheet music all day. It says down. When I look at fundamental analysis of economic data and positioning and all the other stuff, it's a quantitative strategy. Do you understand? It's a quantitative process. There's no thought. In fact, if you think about it, being a human, you're more likely to screw it up than anything. So I have an algorithm do it for me because an algorithm is just as stupid as me, except it doesn't make emotional decisions like I do, like we all do. It just gives me the facts. So I can pick on, okay, I'll pick on this one. I sold Aussie dollar, right? So let's go over there. Look, all right, so I sold Aussie dollar and I'm making money. It's because I'm brilliant, right? No, I'm not brilliant. It's just, look, it's a bearish market. Like, what the hell? What else would you do? Oh, but all the craziness yesterday. I didn't participate in the craziness. Okay? I did not participate in the craziness yesterday. That's not for me. I'm boring. I just make money, or at least I try. So look, this is just factual. Here's Aussie dollar. And I compare these two economies. GDP, inflation, unemployment, interest rate differentials. I look at retail sentiment. Okay, look. It's like 75% of institutional investors are short Aussie dollar. Look, I look at seasonality. It's going to roll over a little bit here, or at least it has over the last 20 years. I'm looking at technicals. It's definitely bearish. Okay? It's a sell. It could be a stronger sell, but it's definitely a sell. Okay, so here we are now at 62.50. What did it say last night? Okay, 63.21 to 63.89. Time to get short, Bubba. Okay. Oh, you mean in here where I shorted? Yup. And now it's making money. Why? Well, look, I don't know. I don't need to know per se. I mean, I do know, but I don't need to know per se, because we do have high frequency type data like, oh, this is about China. Oh, this is about a drop in iron ore and coal prices. Oh, this is whatever. We don't need to know any of that really. I've looked at factual data on the fundamental side, and it's just like, dude, down. Not an opinion. It's just that would be the statistical and economic conclusion based on quantitative analysis. It's just math. That's it. It can be wrong, but it's just math. So the math says, hey, Wayne, you should probably sell this. And then you do the technical analysis. And if it's rallying from 63 to 64, you should probably sell it. Okay, well, let's take a look. So I sold it at 63. It never made it above 63.5, and I'm making money. And I'm like, oh, well, that makes sense. So Jojo says, when will I take profit? Well, I can take profit right now as a day trade. I could hold this until Monday or Tuesday of next week. If the velocity continues, I can get out at 61 because it's a swing trade. Okay. I can say, no. I want to hold this longer term. I want to go for the October low, dude. October low. I'm a boss. So I'm going to move this down to 60. Okay? Or I could really go out and say, you know what? I'm going to go to the technical bottom. I'm going to get out at 56, let's say, and we'll get out a little early. Or I can say, you know what? This is going down. The global economy is going to stay in a world of hurt. There's nothing but blood and pain coming up. This is going all the way down here. And then, of course, I can say, you know what? King dollar is going to stay king dollar for years, at least 2 more years. Okay. You know what? They're all correct. Okay, Jojo? So hours before yesterday's volatility, I got taken out of multiple trades, 5 or 6 trades, all for profit. Some of them, 2 or 3 of them were like 250 pips or more, something like that. So I did aight. Then the big volatility came out. It was all over the place. Whoa. And then I rolled in hours and hours and hours and hours after the news came out and all the volatility calmed down. And I just went back to doing what I did, selling high. That's how I'm trying to teach you. Most of you, maybe 95% of you, are going to ignore it. Ignore everything I just said. You're just going to go back to doing what you're doing. It's okay. You're not hurting my feelings. I used to get very upset about that. I don't anymore. It's okay. I still want to help. I still want to guide. I still want to give you advice. I still appreciate your company. But 95% of you will just keep doing what you do. It's okay. You'll just end this. When I end this stream, you'll go watch some other guy. He will give you some fun stories too. That's cool. Okay. It's all right. But I do want to make it clear the lesson. So again, I did really well this week. But I didn't participate in the volatility. And dozens of you saw me move my stops. You knew where they were. You know what I did. Everything's fine. Then the volatility came out and I skipped it and I sold everything just like the way I did before. Sold those high. I just went back to doing what I'm doing. It's okay. I don't have the excitement or craziness. I guess I could have made a lot of money yesterday, but I also think I could have lost a lot of money yesterday. So I'm back in the game and I'm profitable again. It's cool. It's fine. Boring, I know. But I'd like a couple of dozen boring people like me. And I want to hang out with you because I like you and admire you. And it's still my vision in which a couple of dozen patient, disciplined people that are focused on doing boring trades, we can all work together. Okay, so very cool. So I'm going to like maybe get a couple more on and then I'm going to, I guess, work on, the stuff related to the super secret fundamentally based alert service. Well, that's what I said, Manoj. I got taken out of all my trades for profit. So like I was short Aussie dollar before the news. Okay. And you see these, right? See these? Remember, I was short. Okay. That was my stop is based on that number. So, right, on this candle, I was removed from the market. So, what about all of this noise? The big down, the big up. Honestly, part of yesterday, I played Far Cry 6. Far Cry 6 for the first time in many, 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 many weeks. I just skipped it, and now I'm much more interested in this. I know it's not fun. It's not exciting. But let me tell you, if you ever trade institutional money, they don't want fun. They don't want exciting. Okay? You understand? You want fun? You want exciting? It shouldn't be trading the markets. You should be ruthless. And by ruthless, I mean a tough son of a bitch. You are the most patient, most disciplined trader there is. And you focus your energy on a proper decision-making process. Everybody else just runs around like a chicken with its head cut off, making a bloody mess of everything. But that's okay because barbecue chicken tastes great. So again, thank you for being in my life. I do respect you. Many of you I know and I like as human beings, so thank you for that. As a community here, you give me the strength to get out of bed and do what needs to get done, even if I haven't slept for many hours. This has been a long week and an emotional week, actually, for various reasons. I can tell you that there are a lot of professional investors that are not having a good time right now because of the volatility. things like what happened to the British pound over the last week or so, you're like, man, that was crazy. It dropped 2,000 pips, then it rallied 2,000 pips, then it dropped 1,000, and now there's a new government, now there's a new chancellor of the exchequer, and you're like, wow, we find it entertaining. And maybe you got some good scalps in there, and you're like, look at me, I made 100 pips. Other people are having their dreams destroyed because of that volatility. It's a once in 1,000 year kind of move and volatility. And it ruins a lot of really good people doing really smart things that have been doing it for a very, very long time. This never, ever, 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 ever happens. I don't know if you fully understand that. What's going on in some of these markets right now never, ever, ever happens. So the fact that it's here, it's not all rosy and pink. There are a lot of good, smart people that you would like who are now going through some very life-changing events. And it's because of this volatility that we have in this market. A lot of people have things wrong, but other people are almost like victims of the mistakes that are being made. So I feel very lucky and blessed to be having a good month, a good quarter. Everything's fine. And maybe it's because of us as a team, as a group, maybe. But ultimately what I believe is I am teaching you what I believe to be the truth, the veritas, you become enlightened through knowledge. And I believe 100% what I teach you. That our methods to analysis and trading methodology for entering and exiting trades are very, very good. When things are good, we can make money. When things are bad, we can make money. Now, you can make mistakes and get crushed in the volatility and stuff, but we don't have to be part of the volatility. Other people just literally can't move their trades. So they wake up one day and they're like, the market has collapsed and there's nothing they can do or could have done. The money was already put down. The contracts were already signed. And then the unthinkable has happened. And there's nothing but praying that can be done. And you know, when you're in a situation like that, it never gets better. And so I hope you appreciate the market that we're in and the opportunity that you have and the reward that you will earn by trading properly as a foreign exchange trader when times are good, when times are bad, and when times are neutral. And many people are not as lucky, but you can still screw it all up. I wouldn't, if I knew I had that kind of opportunity in front of me where you're always liquid and you can always change, but you also can base all your trades on facts, technically, fundamentally, everything that you do is rational. I'm telling you, when I listen to people on TV and I'm looking at the market, all I hear is emotion. I think this. I'm worried about that. Well, this other thing could happen. Oh, it's the end of the world. It's the end of fiat currency. Gold is going to go to 10,000. Bitcoin's going to go to 1,000,000. And like, it's all this hyperbole. And I'm like, I just look at the facts. I only know the facts. And I used to gather all the intelligence manually, and it was all kind of all over the place, and I'd make decisions based on all these different databases that I had, and I'd look at this, that, and the other thing. Now, the super secret, fundamentally based alert service I told you about, okay? just gathers everything in one place. And then an algorithm does the math for you. It doesn't trade for you. And it will tell you to sell in a falling market, which is wrong. You sell in a rising market. So you still have to do some smarts. You still have to have some alpha. You still have to sell at resistance. You never sell at support. But I'm telling you, now that I'm helping you develop a fundamental bias so that you only trade logic, and then if you follow the rules of engagement I have been teaching for 20 years, now if you just trade factually with technical analysis, set up trades based on factual fundamental analysis, and you carry it out, what's the net on all of this? I ask you over the last 24 hours or 48 hours, I'm like, what volatility? I didn't see any volatility. Oh, that's because I was out of the market. Oh, why was I out of the market? I hit all my profit targets. And I got out when volatility changed from good to bad. And now I'm back in the market and I'm making money again. I'm like, oh, what volatility? And that only makes me happy because I hope you look at it and say, oh God, like Kanye would say. And that is a major mental, psychological, emotional breakthrough for you. I hope, I honestly do, that you say, that's how I want to trade. Okay? Over 20 years of doing this business, I've seen thousands of ways of doing this. I only know this one. I was the same in the beginning as I am now. Do you understand? When I first started trading and I knew nothing about trading, I made all my trading decisions based on quantitative analysis. Not of fundamentals, because I didn't know anything about fundamentals. But I want you to say, think of it. I was never a trader before. I never traded anything before. I was a venture capitalist, so I think trading stock was stupid. Okay? I bought stock for pennies, not $40 a share. That's stupid, right? So you have to understand where I'm coming from. So when I walk in as a business executive and as a venture capitalist, I walked in and I looked at the markets. Actually, I didn't even look at the markets. Charts were so secondary to what I did in the beginning. So I would just sit down with the spreadsheet and look at the facts, do the calculations, and make a decision. And then I'd open up a chart and look for the opportunity, which I already know that is there. I'm just like, technically, do I have a trade? Think of it. More than 20 years later, I still behave that way. But now I have more and more and more and more and more. I have way more variables. Instead of one variable, I have 9 variables. And instead of just looking at a few charts, now I got 38 assets that I need to calculate all the time in real time, having every single economic variable tracked, COT data for positioning tracked, seasonality tracked, technicals tracked. Oh my God, all these things for 38 asset classes. How do you do it all? Oh, AI does it for me now. So now all I have to do is technical analysis. And I'm pretty good at that too. So I hope you say that's what you want for yourself. And if so, you're in the right place, man. But if you want to get rich quick, there's some kid on YouTube who's been trading 4 or 5 years who's going to show you how to scalp and make big money. He's going to take 8, 9, 10, 12 12 pips at a time. You're going to love it. Go ahead, try it. Try making a career 12 pips at a time. I think if you do the math on it, it'll never work. But for those that like, Wayne, I don't want that message, or Wayne, I can't do the math. I'm not willing to figure out how to use an Excel spreadsheet. It's too complicated for me. I can't overcome that problem. Then whatever. But I can tell you for a fact, taking 8, 9, 10, 12, 20, 30 pips at a time, that's all you do, it's not enough. You'll never get big. Never. You'll always be small. It's like a startup that has a business plan in which they never get out of the garage. Do you understand that? You're saying, I have a great business idea, Wayne, but you can't scale it. Well, if I'm a professional investor, like a venture capitalist, I'm like, you can't scale it? And they're like, no, it's beautiful. It's great. It's great. The thing is, we can't scale. We'll always be a small business. Well, I'm like, well, I can't invest in something that I can't scale. So you might make okay money, but you'll never make big money. You'll always have your little trades and you'll work really hard. You'll make money. You're good at scalping. Great. All the power to you. I have nothing but love for you. But if you do the math, you'll find out you'll never, ever, 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 ever scale. And I don't think you'll ever attract smart money. So the only way you're going to make big money is you're going to have to put bigger lot sizes on your trades, and you are playing Russian roulette with a fully loaded handgun. Well, good luck at that. I don't have much respect for that decision, and I don't think you have a lot of hope with that kind of decision. Kingdom, you're late. I've already done it, so the answer is no, but maybe on Monday, huh? So if you could, guys, please click the thumbs up button, tell YouTube that I'm not a scumbag, and I'll see you guys later. If you're in my day trading group, I will see you on Sunday. Sunday. What am I selling? Gold and Aussie dollar. I think you can see. Peace on earth. May the pips be with you. May our profits be above average. Please have a wonderful weekend. Cheers.